Climate change is the challenge of our time. We all have a part to play and actions we can take. At ING, we act by using only renewable, locally sourced electricity in our buildings and renovating our iconic head office in Brussels so it purifies the air around it. We do what we can to reduce our own impact, but mostly what we do is finance change, helping you play your part. That means enabling you to build greener homes and being the first bank to link our loan rates for corporates to their sustainability performance. That also means eliminating coal financing by 2025. Well, that and so much more. We still have a lot to build. So let's all do our part.
Welcome to all GUBERNA members, directors and certified directors at our 4th Economic Forum in collaboration with ING. Also welcome to the non-GUBERNA participants, and we hope with this event to inspire you, if still needed of course, about the importance of boards, the individual director and GUBERNA. Practically during the event, you will be able to comment, to ask questions via the chat box. Danny van de Vivere, Certified Director, will gather your input and we will try to answer during the panel debate or during the questions and answers at the end of the session. Unanswered questions will be handled after the meeting. The meeting is recorded and will be made available for all participants. Of course, we would have liked to have this yearly meeting live, but unfortunately, COVID decided differently on that. Nevertheless, we want to keep this forum, and I think with the more than 120 participants today, we have created interest on the topic of today brought by Peter van den Houten, Wim van Hifte, and the panel members. With the ESG obligations, COVID and under fundamental paradigm change, does the economic outlook becomes a black box, or will it bring, on the contrary, more clarity in how the economy will evolve? All the eyes at the COP26 climate conference was on governments' willingness to back up their rhetoric on cutting green gas emissions with solid, verifiable commitments. Yet, no matter what the politicians deliver, getting the job done will rest largely on the shoulders of the world's business leaders. Business has undeniably helped fuel the record temperatures and extreme weather that threaten humanity's future. But businesses also have the muscle and the entrepreneurial spirit to move us in the opposite direction. The prime responsibility for changing course lies with the stewards of every company's future, namely the board of directors. Collectively, corporate boards have more clout than many governmental leaders to reverse the damage caused by the climate change. After all, companies as Apple, Microsoft, and Amazon have a market value higher than the GDP of most countries. Trouble is, few board members are adequately equipped for this task. A study earlier this year by the New York University Center for Sustainable Business, which reviewed the credentials of almost 1,200 Fortune 100 directors, found that very few boards across all sectors of the economy are qualified to tackle environmental, social, and governmental issues affecting their company's performance. So, how can boards acquire the tools they need to steer us at a net zero carbon future? And how should they wield their power? A few thoughts. For starters, the recent report by the United Nations Intergovernmental Panel on Climate Change, the IPCC report, should be compulsory reading for all directors. The summary runs to just 42 pages. Next, Every board should discuss, perhaps at a special meeting, whether its company is part of the climate problem and what to do about it. While climate change poses huge risk for businesses, it also represents exciting opportunities, for example, in the form of renewable energy and waste recycling. Having plotted a course of actions, board members should share their plans as widely as possible. They should tell policymakers that they are eager to collaborate to achieve a net zero economy. Each board should release a statement signed by the chief executive and all directors, confirming that they have read and discussed the IPCC report and spelling out what they are going to do to adjust the company's plans and priorities. Beyond these corporate actions, every board should take a hard look at itself. Businesses of all kinds are coming to realize that millennials born between the early 80s and mid-90s typically take a far more activist approach to social issues than their baby boomer parents. Yet, the younger generation's view are seldom heard in the boardroom. What else should directors and boards do? GUBERNA can and will certainly help in this transformative journey. Peter van den Houten, Chief Economist at ING, will elaborate on the economic trends of 2022, followed by Wim van Hifte, Global Head of Responsible Investments and Research at Candriam, who will give a few highlights on the evolution of the ESG landscape. Peter joined the bank Brussels Lambert in '89 in the Economic Research Department. After some time in The Hague as chief economist of the ING Investment Management, he returned in 2001 to Brussels as chief economist of ING. He's a regular commentator in the written press as well as on Belgian radio and television. Together with a colleague, he was awarded in '97 the BNL European Investment Bank Prize for their research on euro conversion exchange rates. Peter is also honorary fellow of the Hohenheuvel College of the Catholic University of Leuven and vice chairman of the Economic Commission at the Belgian Employers Federation. May I ask Peter to come on stage for your presentation. Thank you, Peter.
Good evening, ladies and gentlemen. It's my pleasure to give you the economic outlook for 2022. And if you look at the first picture, you already see that the big theme for 2022 will be inflation. This is a picture from the publicity of Dollar Tree, a US dollar shop, and they just changed their price from $1 to $1.25. So that's what I call inflation, and that's something now you see across the world. And actually, if we look at the economic data that have come out over the last 12 months, and you look at the economic surprises, to what extent the data were better or worse than expected, then you actually see that for growth, data have been deteriorating somewhat. They're now not better anymore than expected, while inflation data are constantly higher than economic forecasters have been forecasting over the last few months. So definitely an issue with inflation. But what about growth? Let's first talk about the growth outlook for next year. There are, of course, a number of challenges. The first one is COVID is still there, COVID-19. We have disruptions in the supply chain. We have the soaring energy prices. And finally, the inflation and the reaction of central banks. If central banks start to tighten monetary policy, of course, this might have a backdrop also for economic growth going forward. Let's first take a look at the COVID figures, and I know you see them every day on television. They're getting quite depressing, and so we have again this new wave with both in the US and in Europe, Delta, but now also Omicron, which is causing havoc. And what to expect? Okay, it's difficult to forecast, but we know that booster shots might have an impact also against Omicron. We know that there are now also antiviral drugs which will come on the market in 2022. And so I think it's still a good hypothesis to start from the idea that from the second quarter onwards, after the winter, things improve again a bit on the COVID front. That doesn't mean that COVID is going to go away. It probably will be endemic, but the impact on the economy will not be as big anymore as it was in the beginning. And you already see this now in a number of countries, that the economy is coping better with COVID and with COVID-like measures. For example, in the US, if you look at the latest economic indicators, then actually they're very good. The neutral level for the PMI, for the Purchasing Manager Index, is 50. We're way above that level, both for the manufacturing and the services industry. And if you look at the nowcasting indicators, they show that growth in the fourth quarter in the US will be around 8% annualized, which is quite strong, and so there's a lot of momentum going to 2022. So that's definitely good news. It's a bit different in China, and what you see here is a shot from a video which was taken at Disneyland. Why am I showing this? Well, because it gives you a flavor of the COVID policy, of the zero COVID policy in China. What happened? Well, just an anecdote, but there was a woman on a train, and she got a message on her phone that she had been in contact with someone who had COVID. And so she had to leave the train, she had to be tested, and so they found out that she also was infected with COVID. And then they asked this woman, where have you been? And she said, yeah, I visited Disneyland in Shanghai yesterday. So what did the authorities do? They closed Disneyland that same day with 34,000 people in it. And those people could only leave after they took a PCR test. So and what you see here on this shot was until deep into the night, people had to queue for a PCR test to be able to get out of Disneyland. But this gives you a flavor of the way the Chinese are tackling COVID. But this is also having an impact on the economy, because they, for example, in August, they closed a container terminal because there was one COVID case. And so because of this very tight, severe policy against COVID, the Chinese economy is suffering from that because they closed down quite constantly activity because of new COVID cases. On top of that, what you also see is that the Chinese authorities have taken action to stop speculation in the real estate sector. And so monetary policy has been tightened. What you see is the blue line gives you a flavor of the tightness of monetary policy. And the orange line are the housing starts, and housing starts are now falling. Why? Because all those big real estate developers are in trouble. You've read articles about Evergrande, but there are other ones that are in trouble. And so because of that, you now see a very strong slowdown in construction. And construction activity is one of the big growth drivers in China, which means that Chinese growth will suffer. And what you see here, the dotted line is GDP growth, which is, as a matter of fact, slowing, and which will continue to slow in the first quarter of next year. So the Chinese economy is not doing that good right now. Fortunately, the authorities already decided now, the central bank this week, to loosen monetary policy, and most probably, let's say, from the summer months onwards, you will see again some acceleration in China. Now, for the time being, this is also affecting the rest of the world, given the fact that China is a very big consumer of commodities. If you look at the small table on the right of the slide, there you see that for some commodities, China is consuming more than 50% of world production. And so when you have a slowdown in China, you see that commodity demand is somewhat slowing too. And you see it on the graph. Real estate activity, the blue line, the orange line is the, let's say, the price evolution of industrial metals. And you see that it's now topping this price evolution of industrial metals because of this slowdown in China. So some prices are already falling, but I have to say that from a more structural point of view, and if you look beyond, I would say, the next quarter and a bit further in time, There will be important demand for metals because of the energy transition. You have to know that for sustainable energy, a lot more metals are used, and the International Energy Agency made some simulations on that. And for example, for metals like nickel, they found out that today only 10% of the demand comes from energy providers, but that will go to 60 or even beyond in 2040. And so for a number of metals, you will see demand quite strong. Also, for example, electrical cars, of course, demand a lot of special metals to construct those kind of vehicles. And so, therefore, commodity prices, they have been in an upward let's say, cycle, which is now stopped temporarily by the slowdown in China. But let's say underlying this upward cycle might continue in the coming years. Now, coming closer to home, Europe, if you also look at the Purchasing Manager Index, which is a cyclical indicator for Europe, and as I said, the neutral level is 50. You also see that in Europe it's still above that neutral level, which shows that the economy is still growing. But it's decelerating somewhat. And of course, with the lockdown measures that are now taken in some countries, for example, in Austria, you have a complete lockdown. In the Netherlands, let's say restaurants and bars have to be closed early. Belgium has also some soft measures, containment measures. But so there are, again, a bit more containment measures in Europe, which will probably slow growth towards the end of the year and in the first quarter of next year. But as I said, the economy is now getting used to it and is coping better with, let's say, with this type of measures. And for example, if we look at the mobility data, which are strongly correlated with economic growth, and the mobility data last winter, so the winter of 2020-2021, we saw that mobility was declining very strongly because of the containment measures. And so we had negative growth in Europe in the last quarter of 2020 and the first quarter of 2021. Now you're also seeing some deceleration of mobility, but not the strong slowdown as we saw last year. So we might face a slowdown towards the end of the year, beginning of next year, but not necessarily negative growth. For example, the National Bank of Belgium today gave some flavor on that, and their model estimates that growth in the last quarter will be 0.2% quarter on quarter, coming from 1.8 in the third quarter. So strong deceleration during the winter months, but not necessarily negative growth. It's not only COVID. As I said, there are also these supply chain troubles. And this graph shows you a survey from the European Commission. And the question towards manufacturing companies is, to what extent is your production hampered by a lack of equipment, of inputs, and by a lack of labor? And you see that more than 50% of European companies say today that their production is hampered by a lack of inputs, by a lack of equipment. And also, what is also very, let's say, extraordinary, I would say, is that there's also a growing lack of labor. Notwithstanding that we come out of a very deep recession, we see labor scarcity also in a number of sectors. And so this is, of course, something which is now also weighing on production. And no better example than Germany, where, of course, the manufacturing sector is still very important. If you look at the weight of manufacturing in Germany, it's still slightly above 20% of GDP, where in the rest of Europe, it's around 10 to 13%. So Germany is still a manufacturing stronghold. And you see that this lack of inputs, especially semiconductors, for example, is now having a very big negative impact on German production, and especially in the car manufacturing production, where this lack of semiconductors is now causing companies to stop production temporarily because they don't have enough inputs. Notwithstanding the fact that the demand is quite strong, because all car manufacturing say today we have strong demand, but the trouble is we cannot produce as much as we would want. And now this is, I would say, in terms of Johan Cruyff, a very famous philosopher and also footballer, he once said that every disadvantage has its advantage, and the disadvantage is that we now have a lack of production because of supply side issues, although demand is quite strong. But this also means that there could be some catch-up in 2022. And if you look, for example, take again Germany as an example, you look at the manufacturing production, which has been stagnating, declining since the second half of 2020. Look at industrial orders. To be sure, they have declined somewhat over the last few months, but they're still way above the level of production, which means that there is still a gap between demand and supply, a gap which probably will be closed in the course of 2022. Now, other drivers of growth for Europe, specifically investments. We believe that business investment will remain quite strong. If you look at capacity utilization today, the blue line, which is quite high, normally with this type of, with this level of capacity utilization, you should see investment growth of close to 10%, which is very good. Also, the consumer is there, and one of the very special things we saw during the pandemic is that consumers saved much more than normal. If you look at the divergence between the saving ratio and their average in the previous 10 years, then you see that savings have been much, much higher. So there has been excess of savings across the world because consumers could not consume as much as they liked because services were not available. You could not go on holiday, restaurants were closed, and so forth and so forth. And that's one of the reasons why the saving levels are so high. Now, I agree with the National Bank of Belgium, who is saying, yeah, but you don't have to suppose that all this excess money which has been saved is going to flow into the economy. Some of it will remain in savings. If people invested in stocks or other assets, they probably will keep it. They will not necessarily sell it to consume more. But you could still expect that the fact that employment perspectives improves, that this reduces the saving ratio. So they don't have to spend this excess savings, which they built up during the pandemic. But if they just reduce their savings ratio, that will already add consumption, more consumption, and that will, of course, have a positive impact on growth. And what you see here on the slide illustrates this point. You have the saving ratio for Belgium in orange, and you have the expectations, the unemployment expectations of households, which were, of course, very high in the first phase of the pandemic, but then declined the whole time, and normally this should also lead to a decline in the saving ratios, which means faster growth of consumption and which means also faster GDP growth. Perhaps a last point on the growth prospects for 2022 is that people say, yeah, and there's also the budgetary stimulus. Now, to be sure, budgetary stimulus on a national level will be a bit less because some of the supporting measures will disappear in 2022. You also have this European recovery plan, but you have to be aware that the grants in this plan, I'm not talking about the loans, but the grants, so which will be given from the European budget to the individual member states, it's not that big. It's big for small countries, for the Eastern European countries, and for the southern countries, it's quite important. There we're talking about 4 to 5% of GDP for the period 2021-2022. But for the northern countries, for Germany, Belgium, France, the Netherlands, it's 0.3, 0.4% of GDP. So it's some stimulus, but it's not that big. So don't overestimate it. So all in all, if you took this all together, so we're starting weakish, I would say, the beginning of the year, but then it will probably accelerate again from the second quarter onwards, on the back of a number of factors that I just called. And if you take this all together, then for 2022, at the end of the day, growth rates will remain quite strong. So we will still, not as strong as in 2021, but okay, the growth in 2021 is a bit special because we had a very deep recession in 2020. We came out of this trough, and of course then you have strong growth, and now we're back at the levels that we had of GDP that we had before the pandemic, so it becomes a bit more difficult to grow so strongly. But still, for 2022, we assume that growth will be above average in most countries that we follow. For example, for Belgium, we will be hovering around 3%. So the growth picture, at the end of the day, remains quite good. There will be some volatility in growth rates, but overall 2022 should still be a quite good year. But what about inflation? I started my talk to say that one of the big features for 2022 is the question on inflation. Was this just a blip, the high inflation rates that we saw, or is this more permanent? Now, if you look at some of the drivers of inflation, for the US and for the Eurozone, then it strikes that energy inflation has been extremely important. The orange line is energy inflation. The gray lines is core inflation. So it are the other prices. And for the US, energy inflation is important, but the underlying inflation, the gray bars, are more important. So you would say there's already some other inflation also popping up in the US, whereas in Europe, at this moment, it's still mostly energy inflation. Now, you might wonder why this big difference between the US and Europe in terms of the inflationary impact of energy. Now, it's very simple. If you look at natural gas prices in the US, since the beginning of this year, they have increased by 50%. In Europe, they have increased by 500%. So they have nearly gone times 6 in Europe. And this, of course, is because the US has a lot of own production, shale gas, and so gas prices are comparatively much lower in the US than in Europe, and that's one of the reasons why Europe is suffering from this high energy inflation. Now, you might wonder, is this something permanent, or was this a temporary blip? And there's, of course, also the geopolitical element with Russia being the biggest gas exporter to Europe. Well, I think if you look at the energy mix in Europe and you look on this slide to the share of natural gas, it is increasing. And it's increasing in the rest of the world. And this is also one of the consequences of COP26, of the energy transition, because countries are moving out of coal, brown coal, and gas is taken as the next, let's say, as the transitory energy source, and therefore demand for gas is increasing quite rapidly. Demand for oil, by the way, remains also quite high. And this is a problem because in most simulations, there's more emphasis on renewable, for sure, and that's good. But the trouble is that you have this very long transition period. It takes some time. And so according to most estimates, peak oil, where we are at the maximum demand for oil, is perhaps only in 2030. Peak gas demand is only in 2040. So that means that demand for these fossil fuels will continue to increase at least another 10 years. Now, the trouble is that energy companies, because they also know that this is a dying business in the longer run, they're not investing that much anymore. And if you look at the investment, at the capital expenditure of the big energy stock-quoted energy companies, which is this blue line, then you see that since 2014, the capital expenditure has been declining. And now we know that, let's say, the capital expenditure is not sufficient anymore to maintain the current capacity of oil production. So that means that we are still facing a period when oil demand will be rising, but oil production will not keep up with this rising demand. Same story for natural gas. And that is one of the reasons why this energy transition in the next few years will be rather inflationary. So, and not only because there's this, let's say, this supply-demand problem for a number of fossil fuels, but also, of course, because you have emission rights, and there's now, you know, that in the Fit for 55 program, Europe is also planning to introduce the emission rights for heating fuels, so for heating of buildings and for transport, which are now out of scope. So this is something which will add to prices, and so therefore, although prices already went up quite strongly, so they will not double again in 2022. But they will probably remain quite high, and in the coming years they could creep a bit higher still. For example, Gazprom, the Russian gas company, which published its results 2 weeks ago, they said that in their simulations for 2022, on average, they don't expect natural gas prices to be lower next year than this year. So people expecting that this is just a blip and that it will fall back quite strongly into next year might be mistaken. There will be a continuous upward pressure from this energy transition on energy prices in the coming years. Now, in the longer run, okay, it's very good that we will go to renewable energy, but this transition period is the difficult period, and so which could cause some more inflation. Now, there are other sources of inflation, and one of them was transport, which is also to some extent linked to higher fuel prices, to higher energy prices, but also there was also some distortion, for example, in container shipping. And one of the things that we saw because of COVID is that ships were taking longer to do their trajectory from China to Europe or for China to the US because of more controls. So they have to also to be in quarantine in some Chinese ports. And that means that shipping has been much slower on average, and so Sea Intelligence, one of the institutions which follows this more closely, they computed that during the summer months, actually, because of the slower speed of the fleet, actually this took 12.5% of capacity. So 12.5% of capacity was lost because of a slower speed. So if you take into account the possibility that in the course of 2022, not only there have been more investments in new vessels and containers, but also that speeds might go up again, you can imagine that transport prices will come down. And we are already seeing this happening a bit. For example, if you look at bulk prices for maritime transport, which is the Baltic freight, it's already coming down quite strongly. If you look at container prices, they are still very high, but we probably have seen the top. So you already see also some decline in these container prices, which transport prices, which is of course good news. Now, does this mean that all inflationary pressures from that side have disappeared? Not necessarily so, because you have this kind of second round effects. And a big number of companies saw their input prices increase, commodity prices, transport prices, costs have been increasing, but they didn't yet, let's say, increase their selling prices. And if you look at the surveys being done by the European Commission, then you see that a lot of manufacturing and services companies now expect that they will increase their prices in the 6 to 12 months. So in 2022, we will still see some second round impacts from this higher cost into selling prices. There's also, and that's very, of course, for Belgium, it's already in the news, all across the newspapers. There's also, of course, wages. It's not only input prices that have increased, but also wages, which are increasing more rapidly in Belgium because of the automatic indexation. But also in the rest of Europe, you see a same phenomenon, but with some delay. If you look, for example, at the negotiated wage agreements, which is the blue line on this graph, they are very, very low right now. But you also see that they react with some lag to higher inflation. So what I've done here is the orange line, which is inflation. I've, let's say, lagged it, given it a 1-year lead compared to wages, and then you see that it's a near perfect correlation with a 1-year delay. If inflation goes up with 1-year delay, wages will go up. So not only in Belgium, where it's already happening now, we will see it across Europe in 2023, and most probably even more in 2022, sorry, and even more in 2023, that wage increases are higher than now. So some of this inflation will be more sticky than the central banks have been thinking until now. So just to give you a flavor of what we expect for inflation, now to be sure, as I said, energy prices, they might remain high, but if they remain around the level, today's level, then on a year-on-year comparison, the inflationary impact will disappear in the course of 2022. And that's basically the reason why most forecasters are still forecasting inflation to fall. And I think that's a good forecast. There's also the fact that, for example, in Germany, there was a VAT increase in January of this year. This will fall out of the equation, which will also push down European inflation. But underlying, there's a bit more upward pressure. And so therefore, what you see, this orange line gives you the core inflation, which is without energy prices. There, it might remain a bit higher than it was in the past 10 years. So that's something that we now are penciling into our scenario. Now, what does this mean for financial markets, for central banks, for rates going forward? What you see is that central banks are becoming a bit less sure about their inflation forecasts. They always said it's transitory, it's just a blip, it will disappear next year. Now, the last speeches, you feel that they are changing, shifting gear a bit on that. And so I was struck by a speech of Isabel Schnabel, which is one of the important board members of the ECB. And she actually mentioned Alan Greenspan, a former chairman of the Federal Reserve, who advocated a risk management approach to monetary policy. And what does this mean? Well, they say, okay, we have our view on inflation and on growth, but we might be wrong. And so perhaps monetary policy should also take into account the fact that there's a risk around our central forecast. And that's basically the reason, because they're a bit less sure about the inflation profile, that we might see that in the course of 2022, central banks start gradually to take away some of the monetary stimulus. In the US, that will go a bit more rapidly. So they will stop, they will gradually reduce their buying of bonds, and they will actually, that's at least what we expect, they will increase interest rates 2 times in 2022. In Europe, for the Eurozone, it's a bit slower. We are a bit less advanced in the cycle, and probably the ECB will also reduce what they call the quantitative easing, as to the buying of assets, of bonds. They will reduce it in the course of 2022, but probably for a first rate increase, we have to await 2023. So what does this mean for longer interest rates, for bond yields, for rates on investment credits or mortgage loans? Well, the funny thing is, or the peculiar thing is, that bond yields actually have remained extremely low. If you look, for example, at the German bond yield in Europe, it has been quite stable over the last 2 years, notwithstanding the fact that inflation expectations, which is the blue line, inflation expectations of financial markets have increased quite strongly. It's now around 2% for the longer run, but bond yields remained extremely low. And one of the reasons is, of course, that central banks, and especially the ECB, continue to buy bonds. And so the interesting thing is that they computed themselves the impact of their bond buying on bond yields. And so on this graph, if you look at the orange line, which is the impact on the 10-year interest rate. And so the 10-year interest rates in Europe is now about 180 basis points lower than normal because of this bond buying. So if you know that this bond buying will be reduced in the coming years, then of course you might expect also that longer-term interest rates start to increase a bit. And I think that the dotted line is probably a good forecast that we will see bond yields gradually moving higher. So let me end just with a final word on exchange rates, and people mostly look at the euro-dollar exchange rate. And we have been surprised this year because, of course, the dollar was not expected to be that strong this year. So there has been an appreciation of the dollar throughout the year. But to some extent, I would say it was probably due to the fact that people were already too bullish on the euro. And why am I saying this? Well, if you look at the speculative positions on the future market you have commercial players who just hedge their transactions, their real transactions, and you have financial counterparties which take positions to speculate on a currency. And what you see that in the beginning of this year, there was a large long position in euros and a short position in dollars. Now, the news flow was perhaps not that positive for Europe this year, where it was a bit more positive for the United States. And so in the course of the year, we saw that financial counterparties were actually reducing their exposure, and that led to an increase in the dollar against the euro. Now we will be starting the year with the opposite position. Financial parties are rather long dollar and short euro, which means that there is already a lot of good news in the current dollar exchange rate. And that's actually the reason why we think that this rally, that this dollar rally, might still go a bit further to 110 or so. Today we're around 113, so we could still increase a few percentage points. But let's say it should stabilize around that level, and we even expect that at the end of next year, the dollar will be slightly weaker than today. So that were a bit the big calls, I would say, for 2022. So at the end of the day, it will be, from an economic point of view, still quite a good year. There are some challenges, but we see decent growth. We see inflation coming down, but remaining a bit more sticky than central banks are wanting. So that also means that central banks start to tighten very gradually monetary policy. But all in all, I think we can look with an optimistic view to next year. So that was it for me. Thank you very much, and I give the floor back to you.
Thank you, Peter. So thank you, Peter, for this rather, I would say, encouraging news. I think this will allow companies probably to focus and to prioritize on another important topic, which will be brought by Wim van Hifte. Wim is Global Head of ESG Investments and Research at Kendriam since 2016. He's responsible for research and environmental, social, and governance issues, the implications for and the integration into portfolio and risk management across asset classes. He joined Kendriam in 2006 after having worked in the academic world for 8 years. He teaches sustainable finance at Vlerick Business School, was visiting professor at ULB Solvay School of Economics and Management. Should you have any questions or comments, please don't hesitate to use the chat box. We will try to answer those at the end of the session. Wim, the floor is yours.
Thank you. Thank you very much for the invitation. What I'm going to try to do today is, just going to test this, yes. What I'm going to try to do today is give you an overview of how the ESG landscape has evolved. I've been in the industry now for about 15 years, and I can tell you that the path we've walked with sustainability has changed quite a bit over the last few years, specifically because regulators have become aware of the possible impact that environment, as social or governance issues can have on our economy and our society as a whole. So undeniably, we are all being impacted, the investment community first of all, but as we are being impacted, you and many people within our economy will also be impacted. So I'm going to give you a little bit an overview of what is actually happening from a regulator perspective and how it might impact companies and the way companies are being managed. But I always start with something that is, it's not the World Sustainability Forum, it's actually the World Economic Forum, who's doing every year their Global Risk Report. The Global Risk Report is a survey that they do, and participants are regulators, policymakers, economists, CEOs from the investment community, pension funds, so a broad scope of academia, so a broad scope of people who are at least assumed to have an idea on what type of systemic risks our economy and our society are exposed to. And what you see is actually a diagram. On the right side, you see visible area, so it's not the full area that you see, and also the risk categories. And they classify actually a few: economic, environmental, geopolitical, societal, and technology. And if you then look at the left side, where you see the diagram, on the y-axis you see impact of an event. So what is the severity of the impact from a societal and economic perspective? And then also on the x-axis, so down, is the likelihood of occurrence. And what you actually see here is, if you look at, and I don't want to dismiss the discourse of Peter, not at all, but if you really look at long-term what systemic risks are, then we see that price stability is there. But if you look at in terms of impact and likelihood, and you compare it to all the type of other geopolitical, societal, technological, environmental effects, well, you see it's pretty low classified compared to other things. What I would like to show you too is this is infectious diseases. What you see here is that actually those experts in 2020 in their global risk report, in terms of the impact, they were pretty correct. They knew that infectious disease, if they would spread around the world, there would be an enormous impact on our economy and society, but in terms of the likelihood of occurrence, they missed it quite a bit. And actually, if you look at what is happening now, 2021, not a surprise. Well, it's actually one of the highest impacts they have in terms of economic impact and the way we are exposed in terms of economic and sustainable growth. A last point I would like to show here is, not surprisingly, if you would go back 10 years ago, and when I was starting in the investment community 15 years ago after leaving the academic world, if I talked about climate change, many people thought like, yeah, this is catastrophic thinking, this is doom thinking, this has nothing to do with investments, this has nothing to do with our economy. What you see is actually over the years, because they publish that report every year you saw environmental events in terms of their systemic impact on economy and society increasing, not only in terms of impact, but also in terms of likelihood of occurrence. And what we have seen in Belgium this year, over the summer, certainly the French-speaking part in Belgium, but also the Netherlands and Germany, that is exactly what we're talking about. The physical impact of climate change on our society and our economy. And this is actually from a report of Munich Re, which is a reinsurer, so they are heavily exposed to everything that relates to systemic risk, certainly also from an environmental perspective, as they are a reinsurer. And they actually track the methodology, climate events across time. And if you see, like when starting in the 80s, when there were climate events, but they were manageable. And if you see now the graph, over the years, it has crept up, it has been increasing every year in a row. But over the last few years, and it's only up until 2017 that they have done the update, probably over the next few years they will do another update, you see there are more than 800 material climate events that impact directly our society and our economy. And I'll show you a graph. They have mapped it actually to insured and uninsured losses for our society and our economy. And I will show you that later on in the presentation. Just to tell you that many of the environmental issues that we've been talking about, certainly since COP21, they are very material and they are perceived to have a material impact, or at some point might have a material impact on our economy. Not a surprise then that regulates, certainly the European Commission that has been very vocal and is trying to lead across the world as being a leader on climate. As you see on the left, there are quite a bit of events, quite a bit of conferences, quite a bit of organizations that have come together to express the necessity to act. And obviously, you know, COP21, Paris Agreement, where for the first time in a long history, nearly all countries in the world agreed upon the necessity to act and have clear ambitions to deal with climate change and to remain, as the IPCC has clearly indicated, below 2 degrees, but now it's even below 1.5 degrees. And based on that commitment that the European Commission, the European Union has done in 2015, they started reflecting on, yeah, but what does it actually mean from a policy perspective and how it's going to impact our economy? And that actually led to what Petro already said, is like the Green Deal and the Fit for 55, meaning that the European Commission has as an objective that they want to be net zero by 2050. Net zero meaning that no emissions in absolute terms by 2050, and obviously we're not going to get there in 2050 just acting the few years before. No, there's a real trajectory being mapped out with interim targets, and that's actually what the Commission has been doing. They have energy targets for 2030 in terms of 55% reduction in greenhouse gas emissions, more than 32% coming from renewables and energy consumption, and then also energy savings. These three things, they might seem simple, but they kind of articulate how our economy is going to be impacted across sectors. So climate change, do not make the mistake. This is not, and I know that many make that mistake when we talk about climate change. They think about solar panels, they think about green energy, but it's much more than that. There is much more to be done across our economy to deal with climate change and energy transition. And as you can see, what the European Commission has estimated, they're talking about between 200 to 300 billion in yearly investments required, both private and public money, to achieve those objectives. So what they have is a plan, the action plan on financing sustainable growth. Well, three things. First of all, reorient capital flows towards sustainable investing. And when I'm talking about sustainable investing, I'm talking about me as an asset manager, but we invest in the economy, so we're talking about all companies, so we're talking about you feeling the impact of the requirements that are imposed on the full investment community, including pension funds, including insurance companies, when we talk about their assets. Third point, mainstreaming sustainability into risk management. I will come back to that in a minute, because we are not only talking about investors, we are also talking about companies better integrating sustainability risks and into their risk management from a strategic perspective. And most importantly, fostering transparency, because it's the key to setting or steering our capital towards more sustainable activities and fostering more long-term thinking. So these are the three objectives of the action plan of the Sustainable Commission, from the European Commission, sorry, on sustainability. What have they done? Obviously, they are, and you might have been informed on this, or you might have read about this in media and press, or via other media. But what European Commission is doing now, they're setting up very different layers of regulation that impact either the investment community, companies themselves, and probably at some point also banks. The most famous one that was the start actually is the European Taxonomy. I will come back to that in a minute. The European Taxonomy is going to have a very, very high impact on our economy across the board and across sectors, undeniably, because it defines what type of activities are perceived to be sustainable. What I think is top about the European Taxonomy, for me as heading the ESG investments department at Camden, it's complex, I admit, but it's very hard to be negative on the European Taxonomy, because it's the first time that a regulator and a policymaker talked about sustainability from activities across the full economy. So sustainability was not anymore about solar panels, about hydro, about some energy efficiency. No, it was really identifying across manufacturing, across chemicals, across transportation, across automobiles, what activity based on physical metrics are sustainable. And working off that, they started coming forward with other types of regulations. So what you see next to that is, and I'm going to come back to that in a minute, is corporate disclosure. So what type of disclosures do companies need to comply with? This is now the Csrd, so the Corporate Sustainability Reporting Directive, which is follow-up on the NFDR. Benchmark regulation, that's maybe less important for you. But then also in gray, what you see is disclosure regulation for asset managers. SFDR, and SRD, which is the Shareholders' Rights Directive. This will have a massive impact on the investment community, already has, but also on you, as companies. Why? We are obliged to report, we are obliged to create transparency. We can only create transparency if we get the data from companies. So there's a whole full chain of impacts based on flows that need to steer towards more sustainable activities. That is SFDR. And then working off that, there are labels and standards across Europe. In Belgium, we have the Towards Sustainability label from Frédéric, which defines the criteria for being classified as a sustainability activity. And we have seen that in France and in Germany too. And that actually impacts also MIF, that is retail investors. They go to a bank, they want to choose a sustainability product. If they choose a sustainability product, SFDR jumps in, because that means that the bank can only suggest a sustainable investment product, a fund, and directly that impacts also you as a company, because it means those products that are being sold to retail, they need to create transparency, so they will need data, so that they will get to companies to have that data. Now, what it actually means is here, I just want to map a little bit the impact here, because transition to, it's really about transition. It's not anymore only about divestment. It's really about transition. What energy transition and dealing with climate change actually means. And the biggest problem is obviously energy. We need energy. Energy at this point is provided by fossil fuels, and nearly 75% of our industrial activities rely on energy somehow. And if we talk about energy, like I said before, mostly it is fossil fuels. And there are quite a bit of sectors impact also for Belgium. We're talking about steel, and we're talking about petrochemicals. We're talking about also, as you can see, transportation. That is nearly 70% of impact in terms of we need energy, so we have fossil fuels, we burn them, and we create emissions. Agriculture, obviously a very delicate issue from a policy perspective, but also agriculture has a massive impact on greenhouse gas emissions. So remember what I said about what the European Commission is trying to do? Well, if you want to deal with the red part, energy, well, it's very simple. We're talking about industrials, we're talking about transportation, and we're talking about energy generation. So improve energy efficiency, first of all. That's what the Commission is trying to do. Transition to more renewable energy, that is also what the Commission is trying to do, and create, obviously, because these are already solutions that are scalable, low-carbon transport solutions. And if you see what it actually means from a trajectory perspective, it seems like a complicated chart, but it isn't. What you see on top is gigaton CO2 emissions per year. So if you include all greenhouse gases, we are now, I think, nearly at 60 gigaton per year. And where we need to get, and that's at the end of that chart, what you see is where we need to get to net zero. So it means that at some point, we need to reduce those CO2 greenhouse gas emissions to zero, where we are now at 60 gigatons per year. And then also, and this comes from the IPCC and the International Energy Agency report, where those solutions come from. And as you can see, it is not only about renewables. Renewables is important, that is on top of the green part, but it's also about efficiency. It's about fuel switching. It is about nuclear still, according to the IPCC and the International Energy Agency, and it's also about carbon capture. I'm not going to dive into the technical details of what it means, but as you can see, there are many types of solutions that are available to deal with climate change and energy transition. And the bottom part shows you actually where those solutions will play a vital role in achieving that objective. And the bottom bar you see is power. Undeniable, when we talk about power, there's no discussion that renewable energy is the solution. But if you look then at other types of sectors, transport, industry, buildings, we're not talking about renewables. We're talking about energy efficiency. Energy efficiency means transport. Make cars lighter. Make heavyweight transport lighter. Because lighter means less energy and more kilometers run. Just to say that those very high objectives will trickle down to many different kind of sectors across our full economy, and they will all have to deal with that. Somehow, in our economic value chain, you are going to be impacted. Whether you are upstream or downstream, you will be impacted by those objectives. And if you look at what the Commission is trying to do, the Green Deal, we're talking about, the numbers vary, I have to admit, sometimes we're talking about less than 1 trillion, sometimes they talk above 1 trillion, but on average they talk about 1 trillion of budget that will be allocated to building a green economy. And as you can see, they're walking through all the solutions available. Clean energy, sustainable mobility, building and renovation will receive a lot of subsidies to achieve that, and then also the circular economy. And again, when we talk about circular economy, I'm talking about nearly every sector you might think of, going from tech hardware to energy, to industrials, to chemicals, to material sector. So it's a very vast impact you see across our full economy. Now, what is the taxonomy? Like I already said, the taxonomy is really trying to identify or come up with a green or sustainability classification of systems, meaning that every type of activity that your company is exposed to, that can be production of some kind of tech, hardware, or offering a service, that can be in food and staples, every type of activity is being mapped within each industry, and then the European Commission has come forward with a classification system, what is green and what is not green, based on 6 objectives. Climate change mitigation, so dealing with climate change, ensuring that we remain below 2 degrees. Circular economy, adaptation, because climate change already has an impact, as we have seen in Belgium. It pollutes water, it has a physical impact on buildings, so climate change adaptation, pollution prevention, and a few others. These are the sustainability objectives of the European Commission, and every business activity will be mapped in terms of their impact, either positive or negative, to those 6 themes. The current focus of the taxonomy is on climate change mitigation and adaptation. So in a nutshell, what it means is, it's a 400-page report where they walk through all the activities and they're going to identify what is sustainable or not. So the taxonomy is not about saying you're a good company or a bad company, not at all. It is just talking about physical performance indicators, for example, numbers of tons of emissions, CO2 emissions, by ton of cement produced, by ton of aluminium produced, number of emissions by kilowatt hour of electricity produced. So these are physical performance indicators, and companies will have to report on where they are positioned and what is their performance. So it's not about being good or bad. It's also not about a financial performance metrics. No, it's really about scientific criteria based on industry evidence, and then determining what sustainability actually means. And certainly, it is not static, because innovation leads to changes in those physical metrics and the way sustainability should be perceived, so it's going to be a dynamic framework. Just to give you an example what it actually means, keeping an eye on time. So they are going to run through all the activities that you see there listed on the left side, and I'm going to give you a very simple example. For example, within manufacturing, cement production. So what they're going to do is they're going to look at cement manufacturing, and they have actually said that the sustainability criteria per ton of cement produced is, as you can see in green, is just below 1.5 tons of CO2 equivalent per ton of cement produced. That is what I mean with physical performance metrics for your company in terms of determining whether an activity is going to be sustainable. Everything that is above is going to be perceived as not sustainable. If it's not sustainable, to complete the chain. If it's not sustainable, that means that sustainable investment products that are offered to institutional and retail clients cannot invest in these type of companies. And obviously, that means it's going to have an impact on capital flows for your company somehow, either via debt, banks, or via equity. So as you can see, the impact is going to be massive. And that's what's going to be the result. That's where Europeans want to go. Taxonomy eligibility. Some companies might have like 80% of their activities aligned with the taxonomy objectives. Others only 10%. I do not have to tell you, if you need to create this kind of transparency to the market, that is going to have a massive impact on your company across governance, strategy, and long-term survival. That it's material, just to show a little bit, don't think anymore in terms of sustainability. That's nice for the tree huggers of this world. Forget about this. This has all changed, and this is just to map you a little bit how important sustainability has become. If you look at the number of bankruptcies in the S&P 500, 90% of those could have been avoided by just looking at our environmental and social performance indicators. I'm not saying that financial indicators have not been important. I'm just saying that environmental and social indicators are part of an assessment of the performance of a company, and more investors, regulators are looking at that. And if you look back to what I said about Munich Re, they have actually mapped also the number, the amount of losses economy-wide based on climate events. And as you, for example, see in 2017, $340 billion in losses economy-wide, of which only 138 were insured, meaning that all the rest is being borne by society. So climate change does have a very material impact on society, on companies that are for partly uninsured, and might also lead to survival of companies. And we've seen that in 2019, where one of the most famous power generation companies in the US, which is Pacific Gas and Electric, went nearly bankrupt overnight because of extreme droughts impacting their infrastructure. That was a company that performed very bad in terms of their infrastructure. All of a sudden, the drought, heavy heat impacted one of their grids, and that created wildfires across many states, and they were declared bankrupt early after. Just to articulate that, I know that you're used to looking at financial statements. I know that you're used to monitoring financial statements and financial performance of the companies that you're working for, but do not underestimate that the intangible part of a company is becoming much more and more important, not only in the valuation of companies from a market, from a quoted perspective, but also in terms of the impact it has on the long-term survival of companies. And what I'm showing you on the right is where you look, this is from an academic study in the 70s, where the value of a company was mostly physical assets. Well, that has all changed. If you look at accounting statements and what they represent or what they communicate or convey in terms of the value of a company, the physical assets have become minimal or marginal if you compare it to the intangible assets of a company. And I'm talking about reputation, innovation, R&D, human capital, etc. I'm going to run a little bit because I have to keep an eye on time. This is from TCFD. Why am I using this? Well, you need to think in terms of this framework. This is for TCFD, is on climate change. This is the Task Force on Climate-Related Financial Disclosure. The TCFD has actually mapped how climate change might impact companies, and then also how it trickles down to a financial impact across income statements, cash flow statements, and obviously your balance sheet. And what you see, for example, here is that climate change, both in terms of transition risk on the left, right, and physical risk. Physical risk is you have a drought or you have floods impacting your company. You rely a lot on water. You have an enormous drought, so it has a physical impact of climate change on the operations of your company, and how that impacts your company from a strategic perspective. So there are quite a bit of risks that you need to map. So policy and legal, I've already explained you that a little bit. Technology innovation might impact your company. Markets, so I'm really talking about commodities, like I said, and when I started in the investment community, oil was like the discussion topic very often. Well, I strongly believe that we will move from a fossil fuel economy to, within less than 10 years, to a materials company. So when I'm talking about markets, I'm talking about commodity prices and the transition of energy, the energy transition impacting commodity prices. And Peter already alluded to the possible impact we might see there in terms of increase in prices and supply disruptions we've seen due to COVID. But don't forget, it's not only a risk perspective, it's also an opportunity perspective. Don't see it too negative. Resource efficiency creates a lot of opportunities in the industrial sector, creates a lot of opportunities in tech hardware. Energy source, product and services, new markets that can be, that might open up to you. So they all have a type of financial impact. The difference being, the bottom part is financial. It's structured, it's clear, it's hard data. Unfortunately, and that's why I've always said I'm a quant, my specialization was data. What I see here from accounting statements is very often backward-looking, and it's standardized. But when you talk about the top part, we're talking about soft, intangible data. There are no standards at this stage, and I know it's very challenging for you, but it's also very challenging for the investment community. They're unstructured, it's non-financial, so there are quite a bit of things that you will have to deal with because regulation is going to impose it. Now, probably there's quite a bit of text here, but I want to explain a little bit what the Corporate Sustainability Reporting Directive is going to be. Well, it's actually a follow-up on NFRD, which is the Non-Financial Reporting Directive. I never liked the non-financial part because I've already explained to you sustainability is not about non-financial. No, it's going to have a very material financial impact somehow, because somehow either you're upstream in the value chain or downstream in the value chain of some company. So all these kind of sustainability issues are going to have an impact on your company, whether you're small, big, whatever, it's going to have an impact. So non-financial is not the appropriate phrase or taxonomy. The European Commission realized that, so they came forward with Corporate Sustainability Reporting Directive. What have they done? They have extended the scope with that Corporate Sustainability Reporting Directive, including listed small and medium-sized enterprises. And they have changed the wording, so now they're really talking where NFDR was talking about mainly environment, climate, and people. Now we're talking about the full range of sustainability information that you will need to provide to the investment community and to regulators. And the principle is simple. NFDR started with the double materiality impact. Csrd has taken that up again. The double materiality impact, what does it mean? First of all, you need to clarify in your annual reports when you talk to regulators and when you talk to the investment community or when you talk to banks at some point, you need to be able to explain how sustainability issues are going to affect your business. So that's the outside-in perspective. But then again, also the inside-out perspective, and that's going to be a very important one and a difficult one, how your own activities are going to impact people and environments. That was NFDR. This is going to be extended to the full scope of sustainability aspect, and that's what you see on the bottom, social factors and governance factors. I'm not going to dive into the details, but social factors, we're talking about human capital, we're talking about equal opportunities, we're talking about pay gaps, we're talking about human rights, labor rights, in not only in your company, but also in your supply chain, so you will be obliged to provide transparency in that regard. And the same for governance factor. So each time, the double materiality principle, outside in, inside out. Just to end this discussion, what does it actually mean for you then, and how you should deal with that? And I often, when we engage a lot with companies, obviously because we are invested in companies, and when we talk about the very large companies worldwide, they are very informed on how they should approach this from a governance perspective. But when we get questions from companies, yeah, but what does it actually mean? What do we need to do? I often refer to a very nice framework that has been set up by the TCFD. It was on climate change, but you can actually transcend it to other types of aspects, social and governance, is that when you're dealing with sustainability, there are 4 layers. You have the governance part, which is going to be most impactful for you as board members. You have strategic part, which is both board and executive level. But then you also have risk management, and we have the metrics and the targets. How do you measure that? Very simple. Governance is, what does it actually mean? Not sure whether you will be able to read it, but just to explain you a little bit, that really means that you're really going to identify whether on a board level there's oversight in terms of the sustainability risks. That can be climate change, but that at least that you clarify whether in regular decision making sustainability issues are being considered first of all, and how they are being considered, and how they're being monitored. And when you talk about monitored, obviously you're talking also about strategy. Is board members and is executive level really looking at the actual and the potential impact of sustainability factors? TCFD was mostly about climate, but this is going to be extended to human capital and more governance-related issues. And when we talk about strategy, we're really talking about look at scope 1 and 2 emissions, also scope 3 emissions, across your full supply chain, but also internally. from your own company perspective. So this is really about mapping the risks and the opportunities that are related to climate, so your emissions across your full value chain, and also the opportunities it might create, because even in the chemical sector, in the material sector, in the industrial sector, there are quite a bit of opportunities that relate to energy transition. If I'm moving down the ladder, risk management, here we're really talking about how the impact is being monitored. First of all, identification, how it's being identified, those kind of risks from a sustainability perspective. And it can be different. Talk about human capital. The human capital risks or opportunities are very different if you are working in the technology sector compared to if you're working in the industrial sector or even in the material sector. So these kind of risks, how are they being identified? How are they being monitored, observed, and how are they being controlled? So this is really the full control framework, and then also moving back to strategy and governance, how they are being integrated at a governance board level and strategy level, and how that communication works. Is there kind of flags, alerts, when there are certain kind of risks popping up? And then the most tricky part and the most difficult part, I admit, for most of the companies, and that's where I'm going to end my discussion, you really need to start thinking from a company perspective, what are my key risks, what are my key opportunities, and how am I going to monitor that? So the metrics and the targets, that can be either scope 1, 2 emissions, that can be, if you're really upstream in the value chain, your scope 3 emissions, because you will have to report on that. That can be human capital. If you're working in sectors where safety and security is very important, you will need to clarify, start tracking, start monitor, what are the KPIs, the key performance indicators that I'm going to look at, how I'm going to monitor that, how I'm going to measure that, and how I'm going to communicate on that. Just to end, just to say that we cannot escape what I've seen happening over the last few years. We cannot escape it anymore. Companies, investors, banks, regulators, policymakers, we're all being impacted by that transition to more sustainable economic development. And when this is a nice cartoon about, when we talk about COVID, I don't want to think too much in terms of doom and catastrophic events, but when we talk about COVID, when we talk about recessions, when we talk about climate change, the impact is going to be there, and the impact can be very high. I'm not sure that technology is going to save us there. Thank you very much.
Thank you very much, Wim. Be assured that Wim and Peter will also be in the panel debate. So if you have any questions, don't hesitate to put them on the chat box. So we will integrate them in the discussion later. So thanks, Wim, for this, I would say, wake-up presentation. And before handing over to Catherine and the panel, we wanted to share a short warming up movie provided by Catherine Leenaerts from What For Ever.
Your company uses electricity every day to power its operations. But are you making the most of your power source? Most firms don't leverage smart and sustainable solutions to store and manage their energy consumption. Are you storing the energy from your renewable energy system and using it efficiently? Wouldn't you prefer a clean energy backup system offering a quiet, reliable and user-friendly solution? Or are you looking for a consistent capacity for charging your electric vehicle park? If this sounds like you, welcome to the energy revolution. At What Forever, we think it's time to rethink your energy mix through a transformative and sustainable solution. How? By extending the life cycle of electric vehicle batteries and converting them into high-quality energy storage units. With What Forever, you can optimize your energy while saving money and without compromising quality and performance. By joining our circular economy approach, you'll help reduce the costly and harmful extraction of rare raw materials required for new batteries by closing the loop. To learn about how your company can benefit from our game-changing energy solution, visit whatforever.be.
So I'm sure that the panel debate, that we will starting out now will shed more light on the formal and leading role of directors in this race. We invited experts with great knowledge, authority, and hands-on experience, animated by a GUBERNA Certified Director in this matter, Katrien de Lange. Katrien, who is replacing basically Jo Hendricks, who's unfortunately on sick leave. We wish her good recovery. And everyone knows Katrien, of course, as independent board member of Candriam Investment Funds, Managing Director, Centre de Bonne Gouvernance Paul Tassin. Katrien is a GUBERNA Certified Director and active member of the Alumni Council. She sits on boards of different organizations and provides also consultancy services in corporate governance matters with a particular focus on sustainability. Then we have Wim, of course you met Wim, I introduced Wim, and then you have Katrien Leenaert, Managing Director of Fibel Auto and Deputy CEO of What Forever. As Director of Fibel Auto, Katrien is familiar with the automotive sector and the recycling sector, as well as the circular economy. Last summer, together with 4 other partners, she founded What Forever, a BV that converts modules from e-mobility into sustainable and circular energy storage systems for domestic, tertiary, and industrial applications. And of course, we introduced Peter, and last but not least, Bruno Colman, professor at UCL, ULB, and Valerik, member of the Belgian Royal Academy, head of private banking, De Groof Petercam. Bruno started at Arthur Andersen and was managing director at ING, cabinet of the Belgian Finance Ministry, CEO of the Brussels Stock Exchange, and Euronext deputy CEO of AGS. Bruno has been advisor and consultant, and after having been the CEO of De Groof Petercam, he is now head of the private banking. He lectures at University of Louvain, the Brussels University, and other entities. Katrien, I leave you the words.
Thank you, Jo. Thank you to all the panel members to be there. So first of all, we also saw that little movie from What's Forever, which shows us that circularity can really maximize the use of the value of products, of materials, of resources also, which is good for the planet, but which is also very good for the company's long-term resilience. However, if we look at evidence, we see that still only a small number of companies really integrate circularity in their strategy. So, Katrien, my first question to you would be, how do you think we could foster the move from linear to circular economy? And from your experience, what is still preventing companies to really go into this circularity model?
Well, Katrien, to my experience, it is really a change. It is really a transition. It's really also a move how to change from circular thinking to from linear thinking to circular thinking. And this needs also guts in the board, guts by the management to change this, to put maybe the figures not anymore on the first place, but first to see what is right for the planet, what is right for the company, what is right for the people who work in this company, and then the figures will follow. The figures will follow. I really think that management and boards need to think more with their intuition and what is really really good for what would I do for myself or for my own house or for my own world in order to be more sustainable. And then I think every company that follows these rules will have more success than another one that is not following these rules and that is still really in the linear thinking world. But of course, yeah, it's a change and it's quite a challenge. But it's also nice that the people where we work with in What Forever, we all really have this set of mind. And you see the more and more people with this same mindset you meet in boards, in networks, that is also our first customer, because when we want to sell a circular battery, also here people say, oh, circular, so maybe it's a waste battery or what? No, 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 it's not a waste battery. Only the modules are tested, and then if we can give them second life, we build them in new storage systems with new cabling and new computer management system for the battery. It's a circular product. It's not a waste product, but it is also already a change in the mind from, oh, I'm going to buy something waste or what? So yeah, that needs quite a lot of change still to be. But we see also in automotive, where I'm mainly from automotive industry. I work already 20 years for Rollout, where we recycle all the cars in Belgium. And there we have a lot of contacts with all the car importers, and also I have a forum with the OEMs in Europe. And it's also there, you see a change. Before, most of the recycling and circular topics were not given to the brightest managers. It were more like the third line managers, and now you see really hotshots on these topics because it is the future.
So change is really starting at the board level. And as you mentioned previously, surveys show today that awareness about climate change, about sustainability as a whole is still quite low. And I would, and there are maybe different solutions to that. Is to change your board, to refresh your board, to get more next gens into your board, to educate your board. And I would like to ask a question to the two professors sitting here, so to Wim and to Bruno. Do you think that the actual education programs in universities or in business schools are aligned with this new economic model we are going to, being that I think that doing business as usual is not possible anymore. I think that Wim really showed that. Maybe we should consider business as a force for good, so a completely different way of thinking. Do you think we are aligned?
Well, I would say that I've been very impressed by your speech, Wim. And to me, the first question is not education, it's about managing the risks, as he mentioned. I think that we are talking about issues that are extremely important, that are part of a global chain, as you rightly mentioned, and that today in companies, and I'm not talking education, there is a lack of knowledge. People do not grasp the whole issue. The issue is that at some point in time, there will be a kind of a rating being associated with the company, and that the whole chain, starting from the company up to the banks and the listed markets, will be impacted by ESG and sustainability. So it's a very big thing, and the companies will be used by governments to certify the processes in order to make sure they would satisfy the criteria. So it's a very big thing. I'm sure that at most companies, the board members are not aware of the implications of all this. And being aware doesn't mean that you manage the risk. So there is a lack of knowledge, a lack of action, a lack of planning. And what I see coming is that companies will be caught by the lack of time, by the lack of ability to make the changes, and that may impact severely their financial performances. Let's take one example. I'm working at a bank. We all know that the cost of credits, mortgage loans, but many kinds of credits, plain vanilla loans, will be impacted by the ability of a company to be up to some ESG or sustainability criteria, meaning that there will be a certification will have to be granted at some point in time, and that it may hurt the financial situation of a company. So this is the number one priority. Talking about education is a second thing. Wim teaches at several universities this kind of topic. It will come, but we are not there yet.
So maybe what you say, Bruno, is investors, whether it be banks or lenders, will really push companies to
the pressure
to accelerate their pathway to net zero. You agree with that, of course, Wim?
Yes, but there's still a long way to go. I think I admit that I've worked in the academic world for quite some time, and sustainability. When I left the academic world, sustainability. I've heard about sustainability before, but I'm a financial economist and financial mathematics. Sustainability was really new for me when I arrived at Kendrium. There was not in the DNA nor in educational courses. I'm talking about the 19s, obviously. Although we were aware, and I had a discussion with Jean-Pascal van Ypersele a few years ago. We were regularly in roundtables. And obviously from his perspective, it was part of what they educated, obviously, because he was a specialist in that field, as we all know, and he was very renowned for his knowledge. But if you then talk about my department's economics, financial management, that was not part of educational courses, and obviously if it's not has been part of educational course, we're all being impacted because now we have all responsibilities, either as board members or as executive level, or myself in the investment community. If you don't have been educated on what it is and why it's material and how you should actually manage those type of risks, but also create opportunities, because it's not only a risk perspective, it creates a lot of opportunities across many industries. I think education is a very important part and is the start. I think that talking to young people, sustainability is a no-brainer for them. They find it very obvious that you integrate that. But then if you talk about my age and a little older, well, many people are still thinking about, but is it impactful? And sometimes events happen, like we've seen in Belgium, and all of a sudden it's like, oops, this has a real physical impact. So it's a catastrophe for people from a personal life perspective, but it's also our economy is being impacted. So back to academia, I think it's starting at business schools. Some business schools are already a little bit more specialized than others. But I think if you compare to asset pricing and macroeconomics, as we have all been taught, we are still a long way to go in terms of integrating that into, even central banks have admitted that there's a lot of things to be considered, a lot of research to be done, to have frameworks, because that's what board members need, that's what the investment community need, that's what central banks need, that's what banks need, frameworks that allow them to judge the impact of not only climate change, but sustainability. And I want to maybe address one point on circularity, and that's what the European Commission has seen too, is there's an enormous difference between dealing with climate change and dealing with circular economy. Why? Climate change is either as a company you're being impacted from a risk perspective because your company is a high emitter, or you're being impacted positively because you're an enabler. You're a company that are offering solutions, so that's more like an opportunity. When you talk about circular economy, it's completely different because it's a change of attitude. You're really I'm looking at a company and how do I change from product design, strategic-wise, to then when I put it in the market and take it back. That's the full cycle of a company from cradle to grave, as we say it. Rethinking that process. So it's a really completely different scope. And then back to education, it requires quite a bit of education, but then not only from an economic perspective, but also engineers, etc., that need to really rethink products and services.
You talked about the impact of climate change, and taxonomy is really focused on environmental aspects. Should we also have social taxonomy, where we take more also into account people, workers, and so on? What do you think, Peter? Do you have an idea on that?
Yeah, well, if there has been already some research on those topics, and what Wim also said during his talk is that the risk of bankruptcies not necessarily only depends on the financial figures, but you can look at a number of other metrics which apparently also, let's say, better forecast the risk of failure. And indeed, what we've seen in some research in the US already is that the companies devoting a lot of attention to climate issues, but also to social issues, that they at the end of the day come out better. And because, let's say, if the boards and are more focused on, let's say, on the broader consequences of what the company actually does, both externally but also internally, yeah, because it's not only about the social impact on the people around the company, but also what you see is that there is also a lot of emphasis on actually how companies treat their employees, and which is coming a bigger issue for a number of companies. But the good news is that actually is that you see the companies that score good in those areas at the end of the day also perform better on the stock market. And yeah, if you take these kind of links, then I think it's a no-brainer for boards to advocate this type of behavior and policy.
Bruno, you want to add
yes,
something?
I would like to add something. When we talk financials, at this stage, one cannot make a huge difference between sustainable companies and the other ones in terms of financial performance, but it will increase over time. And my intuition tells me that the risk premium that is associated with expected cash flows related to any investment project, or even to the discounting of cash flows when you try to price a company, will increase. The companies will be unable to be up to the new standards. And so, and the thing is that it will not happen, it may not happen overnight. It may take a couple of years, but it's like digitalization. 10 years ago, there was not that much of a difference between companies that were digitalized or not. Today, the gap is so big, you know, it's unsustainable for the companies who lost track of the IT progress some years back. It's impossible to cope with that. And the same will happen with sustainability.
But maybe climate change is more a systemic risk, don't you think? It's cover everyone,
de facto
everything.
It's systemic, because you cannot diversify away that risk. That's why all the parties have to work on that together, and the impulse will come from the inside of companies, but of course from governments as well.
Maybe just coming back on the theme of the debate before going on to questions, because there are a lot of interesting questions. So maybe I will start a little bit earlier with the questions. But I wanted to know your impression about this race to net zero, because we have seen since COP26 a lot of great announcements from private companies, also from smaller companies, that they want to be net zero by 2030, 2050. And I wanted to have your sentiment on that, because without plan, of course, this looks just like marketing. And this is also, I think, a reputational risk for the board at the end of the day. So what's your view on that? Who wants to?
Yes,
Catherine?
I really am a little bit, how you call it, scandalized. Scandalized meaning, how can you say that in 2050 you are going to do this or that? Stop saying and stop making such a long promises without any concrete action plan. It's stupid. It's like, I remember always Thomas Rau. I saw him a lot of times, and the guy of From Cradle to Grave, and etc. He always says, yeah, what do you think when my wife would accept that I would stop in 2030 cheating her? It's shit. It's such a lousy promise. You really need to do things now and have an action plan now. And that is really a pity also in politics. A lot of things are put on a long line. Okay, it's on the one hand, you need to be realistic. You cannot change the world in one day. But on the other hand, it's much stronger, I think, for boards, for companies, to make concrete progress. To say, this is what we've done this year. And not to say, we will do something in 2026. That's, to my opinion, it's not working in the end.
What about offsetting? Can anyone pick this one?
Maybe briefly, I think what I've shown is, I know there's offsetting has been an issue for some time now, and offsetting is part of, we should not forget that offsetting is part of the solution, because some sectors will not be able to decarbonize by definition. And Belgium has a few of those sectors, so we need to be conscious. But I think in terms of offsetting, that cannot be the objective. That can only be the lender of last resort, I would call it, because the first objective is decarbonize the economy. And that is the first objective, and there are many ways to do that, energy efficiency, like I said, or shifting in terms of from fossil to something that is more renewable. And offsetting can only be, in last instance, when you can't fully decarbonize, you can offset a little bit, and deforestation or reforestation is obviously a very important solution to get to net zero. But it cannot be that a company also related to net zero would say like, yeah, I commit to net zero, but I'm going to do offsetting. Yeah, but that is not going to work. If everyone would follow that track, then it's not going to work, simply.
Anyone picks? No? Then maybe, yes, Peter?
Just add one thing. The problem with offsetting is also that it leads very often to double counting. So in the countries which plant the forests, the offsetting forests, and to, I would also say, to fraud, because let's say companies buy some peace of mind, but at the end of the day, who is really controlling whether this is done correctly, and so forth and so forth. So therefore, it's something, but it should, if it would be a solution, then at least it should be better regulated, that if you offset really, that you're sure that it's done and it's done properly. So, but that's not the case right now.
So I will go through some of the questions, because there are quite really a lot. Maybe starting with Ewout, and he's asking, is it possible to debate on how to achieve a green economy through the actions mentioned in the presentation, without questioning the cult of exponential growth? So I think he wants to know if we can have an infinite growth within an infinite planet, something like that. Is it possible to still have GDP growth?
The answer is probably no. You know, there have been many theories since the Industrial Revolution, including the one of Malthus. But definitely, all the theories and all the perspectives that have been drawn were based on infinite resources. And we know today we have a big issue. And so we will have to live with a lower growth level in the coming years going forward. There's no doubt on that. And I think we are starting to feel the shift, and we will get used to it, no more, no less. And thinking that human progress will always overcome the limitation of resources, according to my humble experience, is a mistake.
Yes, but there's the big difference between
optimistic and pessimistic.
Between subdued growth and degrowth.
I never mentioned degrowth.
No. But I mean, but some people say, okay, it's not possible. Growth is not possible anymore. And there, I think what you see, if you look, but if I'm not saying that you are advocating degrowth. But let's say if you look at the energy use per GDP unity over the last decades, it has been going down all the time. So there's a possibility to grow with, let's say, lesser use of energy. So growth is still possible, but I agree with Bruno that probably growth will be slower. Now that is a kind of problem, given the fact that even slow growth is already a strain on our social system, because for example, the pension systems in most European countries are based on growth, and if you don't have growth, then it becomes more difficult. So I think that's a very big challenge to have growth, which is which is not using that much energy or no energy at all anymore. So which should be quite hard a task to do.
But it's a larger issue than that, and I fully agree with Peter. I think that it has also to do with the political system we want to live in. If we want to live in a very selfish system where individual prosperity should be reached at any price, it will not work. And definitely there will be a dismantling of the social order. So the sustainability issue, the ESG issues are part of a bigger equation where we have to consider living together in a world with limited resources. And the interaction of the people is something that we have understood since the COVID crisis, better than at any point of time in history. So the geometry of the world will change.
Maybe add something to that, because if we talk about growth, there are many things. It's not only sustainability, demographic evolution having a very important impact too on growth. But to be frank, I've never liked when they talk about green, they talk about sustainability and they talk about green growth, but that's a political issue because they don't like to communicate or convey a negative message about needing that transition. But unfortunately, if you look at the reality, it's not always going to be without pain, that transition. There are, green creates effectively a lot of opportunities. And I think Belgium certainly, and a few other European countries might be very well positioned, but it's not that all sectors going to be, will not feel the harm. So green growth, I agree I fully agree with Peter when you talk about growth and in terms of fossil fuels, energy density very high, but if you look at but you said it better than I do, per output, you see that less and less energy is needed, or there's innovation going on. That will need to keep, that we need to continue that type of progress. But saying that the energy transition is going to be painless, I know that politicians and regulators don't want to convey that message, but it will not be painless. It's pretty obvious that certain sectors are going to be massively impacted. And the fact is, and that's why it's important that board members and companies deal with that, is it's starting now, reflecting on where I'm going to see that impact. Is my company talk about digitalization? I fully agree, Bruno, that digitalization a few years ago, 10 years ago or 15 years ago, those that were not prepared, they pay the bill now in a way, and it's going to be the same with, so planning now, not only being aware, because aware is not enough, it's really about planning now, mapping all the risks, and then unfortunately for some companies there's going to be a severe impact. For others it's going to create massive opportunities.
If I can just add one more thing, because I'm also thinking a bit on the social issues involved with this, what Wim is calling the painful transition to greener economy. If we remember that in France, the Gilets jaunes movement started because of, let's say, a higher price for fuel. And what we are now seeing also is that this transition to some extent makes energy more expensive, which is of course a bigger chunk of the budget of the lower incomes. And the question is how this kind of problem will be socially managed. So in that regard, I'm a bit afraid of whether the political and social context will evolve in a way that will allow a smooth green transition.
The European Commission is aware about that. They are thinking about the Just Transition Fund. I'm not sure whether it's going to be enough, probably not. But there are examples, and that's what for companies, boards, executive level, executive management, they need to plan ahead. And there are examples, for example, in the utility sector, I'm not going to put a name on it, but in utility sector in Italy and Spain, there have been a few exemplary cases where utility companies need to get away from coal-fired power plants, and they actually integrated employees into that process, reskilling, reorientation, and that is what's going to happen across the board, I think, across sectors, and that always starts with governance, so at the highest level, boards, executive management, planning ahead, getting human capital into that story, so it's about risk management and planning.
And Maxime is asking a question in the same sense. Is there room for activism in the boardroom?
Yes. There will be activism in the boardroom, of course.
But I want to be careful with that. Yes, there is need for activism, and we do it. And I think with many of our competitors, between brackets, in the asset management industry, there is more and more activism. But I would not call it the type of vulture capitalist activism that we sometimes have seen, and certainly the US is very famous for it, where it's actually more accepted there, that type of activism. I think in Europe there's a different attitude in terms of activism. It's more like being vocal, sometimes work with board members and
engaged, more engaged.
Yeah, yeah.
But you may see companies being sued by individuals. I think since we are moving gradually toward a US kind of society, you will see activism, more and more activism. Look what happened to Shell in the Netherlands. And definitely the markets, the population may exercise a pressure on companies. I think we should not underestimate that. And I think that that's why I was saying at the start of my speech that at the board level, people are not at all enough aware of the magnitude of the change.
Hasn't that changed a little bit during the global financial crisis, where we have seen people in the street came to where when they were shareholders to banks, and they were very vocal. And it's not sustainability to me that created that. It's actually the global financial crisis created a lot of thinking about responsibility of board members and
Roland is asking, as Belgium is mostly a country of non-listed companies, how do you see the rollout of Csrd at the SME level? And I think this is a quite interesting question, because SME always think that they're not involved in the European regulation, but at the end they're all part of the supply chain, so they will be affected.
First, there are many small companies that are owned by listed companies, more than we think.
Yeah.
Second, the pressure will come from the profitability of these small companies, because they will be hurt. The ton of CO2 will increase, banking regulation will increase the price of credits, and also there will be government regulation coming at some point in time. We haven't seen that wave of regulation. We see the start, the first drops, of what's happening, but 10 years down the road, it will be a big thing.
But Csrd is coming. When?
Yeah, I think so.
Yes.
Yeah, there's no
way back.
There's no way to escape that, I think, because I don't see how, Bruno also working in the asset management industry, I don't see how regulators could impose regulation on the investment community and then not walking it, and also going to companies and kind of obliging to be transparent, because otherwise it's broken. It's like we say it in Dutch, de paard voor het kart, en en français on dit le chariot avant le bûche. Yeah, that's impossible. You can't do that. So yeah, it will come. I'm not saying it's going to be easy.
Yeah, but anyway, it's going to go through the banks, like Bruno is suggesting. Yes? So, given the fact that SMEs mainly or entirely rely on banking financing, and then we now see that in prudential controls that the ECB is already obliging banks to be very transparent on the climate risk and other risks in their portfolio. So the costs for companies not abiding to the new reality is going to increase quite strongly.
Yeah, I fully agree.
Pierre-Henri is asking a more technical question. We easily understand how embedding ESG into business will likely increase enterprise value. Have you found a clear narrative to link it to intrinsic value creation?
Well, if you talk about enterprise value, partly is intrinsic value. It's what you have, and so it's for me a one-on-one actually. But it's the, like I shown you before. I think I always give that example of Kodak, who was actually the pioneer in digital cameras, but they lost the battle because they completely misjudged the trend. Absolutely. So what is intrinsic value? Intrinsic value is the full scope of what you're exposed to. And I fully agree with Peter at some point, as we are, unlike Anglo-Saxon world where financial markets are, even for SMEs, very important in terms of the financing. Belgium is very different, but I fully agree with Peter. Banks will at some point in their capital reserve ratios, so it trickles down to their credit portfolio, so it trickles down to the interest rates they're gonna charge to the companies on their credit side.
Yes.
Julia is asking a question with respect to board's competences, and she asks, do you expect that next to the traditional board committees, sustainability/ESG board committees will be enforced to advise boards due to complexity of the subject? So I don't think we need scientists in the board, but we need people who are aware and who are able to understand the risks for the company, as you said, and to integrate it in the company's strategy. What about putting in place specific boards, committees? What do you think about it?
It will happen, and I think that in the meantime, the Big Four, will understand the added value they can provide, and they will build up dedicated teams to address these issues. It's coming. Because there is a lack of people.
Yeah, I agree. I think what we currently now I can't talk for SMEs here, but what we're currently seeing in certainly with large cap companies more and more, certainly in the energy and material sector, investors are requiring specialists on climate in boards, and it has happened at quite a bit of energy companies and utility companies, where board members had to re-elect it, resolutions actually voting against, because they don't have the required knowledge. Certainly more and more at large cap companies within the energy and utility sector, that is currently happening. Voting against board members because they lack the knowledge. But that is only, it's really early days, that is only just starting. And effectively, then it's not about having board members with financial knowledge only. It's really about board members that have very detailed expertise on.
Yes. I will give you an example. In the banking sector, if you want to be a board member, executive or non-executive, you need to get a fit and proper certification. And today, one of the requirements is that you are aware of the ESG issues and ready to act on them. Meaning that if somebody is totally unaware of these issues, he will not be retained, he will not be certified by the regulators. And this is already happening today.
Another question, do we see early evidence that the cost of capital or debt increases for companies that are less sustainable? As a board member, can I trust that doing the right thing for the planet and risk will be rewarded for my company, especially in the absence of appropriate KPIs, standards, and measurements?
Yes, that's already the case.
That's already the case.
Academic research has shown that on credit spreads, quoted companies, so credit spreads of more sustainable companies, whatever the metric might be to measure that, and the difference is big, very big actually. We're talking not about a few basis points, we're talking of several hundreds of basis points between the best companies. And I don't want to say that it's only related to sustainability, because I think we should not think about sustainability as the Valhalla and the solution to everything. It's just part of the DNA of a company, I think. Being appropriately managed is taking care of human capital, is taking care of the inside out, outside in, so the double materiality. Yeah. I don't see why even a small company should not think about these kind of things. And probably for SMEs here in Belgium, as it channels through banks, it might take a little longer before they're going to feel the impact. But if you look now across Europe for quoted SMEs and mid-cap and large-cap companies, it is already the case. That capital, discount rates and the credit spreads are massively lower for more sustainable companies. So that's even not a discussion point. That has been proven.
That has been proved. Okay. I saw also a question from Mieke with respect to inflation, maybe for you, Peter. How do you see the consumer's attitude will change on price increase impacts following inflation and cost of sustainability?
Yeah, well, then I'm coming back a bit to this Gilets jaunes story, and I think for the time being, yeah, it's still manageable. But if we see, well, if the consumer, and especially consumers with lower incomes, will see that energy is taking gradually a very big chunk out of their budget, then I can expect that it can lead to more political polarization also. That is, and it's something where let's say extreme parties thrive on this kind of disgruntled consumers. So in that way, and a bit referring to what Wim said on the European Commission, that they are aware of it. But let's say government should also be aware of that. That if they are not managing this transition carefully, that they might end up with a very polarized country, and which is hard to govern, which is already the case, but it might be even harder then.
And what if inflation really starts to remain very high, and that we have some interest rate hike from the central banks? What effect on the public debt, on the global debt, and on the fact that I think with what you said also, Wim, climate change, the effect of climate change on our economy was huge in 2021 and can be even larger in the next years as climate change will only maybe accelerate and intensify. So what about the capacity then from governance? What they do today is to jump in and to support economy. What about what if the debt cost of debt is rising a lot?
That's the biggest issue that we will face in the coming years. Today, rates are low because the central banks are printing money like hell. They control the full yield curve. But we have forgotten one important thing, the risk premium concept. And if one day the risk premium is associated with sustainability issues, it may increase. So it may, but then it will make a difference between companies that can cope with that and companies who are unable to cope with that, like I was talking about digitalization. And that's why companies have to make choices today, as Wim rightly mentioned. It's not a question of decades, it's a question of months. And I think it should be a topic number one at the board level in most companies.
Another question, is the panel predicting the end of Uber, Deliveroo, Amazon due to lack of social sustainability?
Let's see.
Yeah, actually, the funny thing with Amazon is that in the United States, it's for lower skilled workers. It's one of the best payers, actually, and they're now doing some. I'm not defending Amazon here, but what they have seen is that when Amazon comes to city, it was research that was published actually last week. Then hourly wages go up across the city because they're paying a higher starting wage for lower skilled workers, and so the other companies have to follow. So it's Uber, and is perhaps another question because that's also another type of company. But actually, in that regard, that might the social component for some of these companies might indeed be in a later stage also a hurdle. I can imagine that it's something that will become also more important, also in the minds of governance, because if the attention of investors goes more towards these kind of issues, you can also expect that at the end of the day, the authorities become also more vocal.
There is a question about the risk of failure from the EU, who is leading this big sustainability plan. What if the EU fails? What if in 2030 the Fit for 55 is not reached will this cause a major problem to the euro with respect to confidence, with respect to trust? Because I think this is also a very important factor.
It's an extremely difficult question to answer, because obviously, I remember the discussion I had with Jean-Pascal Van Yperseel on this subject. Obviously, there's so much scenario analysis and distribute, because we're talking about distributions and what is the possible impact. It is very difficult to estimate, and he mentioned then terra incognita. We don't know actually what's going to happen, but it's pretty obvious that like the charts I've shown from Munich Re, which is a reinsurer, which is actually at the basis of measuring systemic risk, because they are hugely impacted. It's pretty. I can't predict what's going to happen, but you don't have to be very bright to see that even Belgium is being impacted. Look at the US. California, look at South Africa, droughts, what type of impact it has had in Australia. Huge. This is not gonna go down. No, on the contrary, it's gonna become worse, and then the impact in 2030. I don't know. But if you look at all trends, well, it doesn't bode well for the future. And if we, unfortunately, and that I admit, unfortunately, it's not only going to depend on the European Union. Even if the European Union is going to succeed, it will not be the European Union alone that's going to be able to deal with climate change. Therefore, the US and China and also India is too important to also deal with climate change. But however, I may hope, I'm not sure whether they will walk the talk. Somehow, my feeling is that the ambition of the European Union is starting to have effects across the globe. China, ETS, borders, that carbon adjustment mechanism that they're thinking about. Obviously, a lot of pushback from the US and from China and India. So, what if they fail? Well, if European Union is failing, well, then probably all other countries are going to fail, and then the consequences are going to be massive. What are the consequences going to be? I can't say. The only thing I can say is what we currently see doesn't bode well for our economy, for sure. So the only thing we can do is plan ahead and together with regulators, because it's not only investors. I think there was too much talk about investors. It's not only investors, it's companies, it's regulators, it's everyone needs to address that.
And what about the introduction of eventually a carbon tax to accelerate really the?
It may happen.
It may happen. Would that be an accelerator to really go much quicker?
A progressive tax, but this is one of the events that companies have to factor in their financial projections, because if the ton of carbon price would go up to 100 euros or 200 euros, it will create a discipline and a disparity among companies. And so this is the kind of thing board should work on as soon as possible, because it means that the financial projections companies are making over the next 5 years may be definitely changed by that.
Peter, what could that have as effect on growth if we have such a tax?
Well, it depends a bit where if it's introduced across the globe or not, because I think, and also chipping in on what Wim has said, the border adjustment I think would be a very good thing, because it would, at the end of the day, it would impose the European regulation on the rest of the world, because you have one of the biggest markets in the world for consumers, so everyone wants to export to the European Union. And if you then have to pay this adjustment tax to be on a equal playing field, then at the end of the day, other countries will also have to introduce a kind of mechanism to control or to tax emissions. And then at the end of the day, you're at the same playing level, and which where I don't see massive impacts on growth. Of course, if it's only one country or one region that introduces it, it's a bit more tricky, because then you could lose growth to the rest of the world.
Okay, we are running to the end. There are quite a lot of amazing questions, but I propose that we will answer them a little bit later. I would ask to you a last question. What would your recommendation be to boards today to really start and not wait until they are forced to act? What would be your recommendation, knowing that I see here a quote from Abigail Levrault, who is our board member of GUBERNA, who is stating that GUBERNA will definitely provide more sustainability trainings from 2020 on. So that's already a good news. What would be your recommendation?
I would say make a 10-year projections in two scenarios. Everything went well, everything was a collapse regarding these issues, and then discount all these events to know what are the decisions that should be made today. Because boards need to be aware of where they are heading to in case they do not understand the magnitude of the change. As simple as that.
Yeah.
There's kind of sensitivity analysis.
Peter, your recommendation?
Yeah, this is already quite complicated what Bruno is suggesting, but yeah, I think that the very first thing is that it's stupid, but it's to acknowledge that you cannot wait until tomorrow anymore, because it's as Bruno explained, it's already happening, and if you're not acting now, you might lose out against the competition at the end of the day. So I think it's really the first thing is to be very aware that to some extent it's a burning platform, and that something has to be done now.
Catherine?
Yeah, my recommendation would be very simple: buy a circular battery or whatever. Then you can have more renewable energy, and you can maximize your own production, and you can store your energy, and then you can use it. That's an easy one, but yeah, really start thinking circular, open your mind, stop linear thinking. That's my advice.
Great. Wim?
I would refer to what I've shown at the end of the presentation from the TCRD. I think it's a very simple but nice framework, and the way you turn it in the end, it starts at the governance level, so board level, and it's really about starting the discussion. I think that's the most important thing, and probably you may not be educated, or you may be educated enough, but you need to start the discussion. What does that actually mean, sustainability, and do we have impact or not? And I think with what the European Commission is providing in terms of white papers, what they are planning, well, if you just start reading one and you start reflecting on, how might this have an impact on our company, and then you can start board levels, executive level, and then it starts, and then the ball will start rolling, and everything will follow, I believe.
So use the frameworks which are already in place by the EU can be a good tool to help you.
In the end, it's the board and the management level who provides the levers for whatever happens after that they can deal with those risks. So and if you don't start reflecting on it, I think in the end, I believe you will end up with what Bruno just said. You're gonna probably. You plan ahead, so you will have targets. Now, you might have growth targets, sales targets, earnings targets. Well, probably you will need to think about 5-year, 10-year growth. That's what we estimate. Oops, but we will be in a different environment. How is it going to impact my earnings and my sales? And then you start thinking about today scenarios, and then it all started. And don't oversimplify, but don't make it too complex neither, because otherwise it becomes unmanageable. Certainly for SMEs, I think, if you're talking about big companies, large cap, for them that's really complicated. But start small, and that is at a governance level, start mapping those risks, targets, and then your future targets, try to infuse that sustainability in terms of how it's impacting your final targets.
So act now.
Okay.
Well, as fast as possible, I would say.
So thank you to the panel for your inspiring insights. Thank you also to the audience for their great questions. And I think that now I give the floor to you.
Yes, thanks. I would say thanks for the amazing answers. I'm quoting Katrien to the amazing questions of the audience. So maybe not all questions has been answered, so we will try to do that afterwards. But at least we have one question for you, which might help you answering a lot of questions. And this before giving the stage to Sandra Gobert, Executive Director at GUBERNA, for closing this event. We wanted to get your input about your interest in following a course at GUBERNA on climate adaptation governance. So thanks for answering the poll, and I give the word to Sandra.
Thank you very much, Joe. I have the challenge tonight to close the session and to summarize the rich contributions and insights of our speakers of tonight. It is a very important session for us because it opens our theme for 2022 and the years to come, which will be CAP 2030. We will be back on that, governance in transition. It is certain that we live in a world with limited resources, as Bruno Coleman highlighted tonight, and that climate science proves us that unless there is immediate action, and if I say immediate action, I'm referring to large-scale reductions, limiting global warming to 1.50 degrees will be impossible. It will be beyond reach. And then we are talking all emissions, all kinds of emissions, CO2, methane, and other greenhouse gases. Every ton of greenhouse gas from now on adds to global warming. But there is also positive news. As it has been stated, meanwhile, the European Union is beating the target. Of course, it is partly due to COVID, but still, we are beating the target for 2021. We are the only region to do so, and on top of that, we are the only region that is heightening its ambition. The EU, it has been also highlighted by Wim van Ifte, is taking leadership, and it is certain that regulation is coming. There was regulation foreseen on the 8th of December. It has been postponed to the month of March, but it is coming, that is a fact. Of course, even if we change our attitude and we move to circular economy as pleaded for by Madame Katrien Leenaerts, and even if we need today less energy per output, as Bruno Coleman also highlighted, energy is and remains precious. Energy demand in the world keeps increasing. If we don't want to change fundamentally the way we live, we cannot do without energy. But we have to go through this very complex transition that is in front of us and that is today still full of uncertainties. So this is a huge challenge for companies and for boards, because energy rethinking is possible. Technology and innovation can save us, but it needs time. Energy rethinking needs time and it needs investments. So energy rethinking needs courage. These are three tremendous challenges, especially for boards. And unfortunately, research points out that boards have a tendency to maintain the status quo. And if there is something that we don't need today, it is to maintain the status quo. So we cannot hide anymore. It has been highlighted tonight. We can win time, but not a great lot of time anymore, since regulation is coming very quickly. Also, there is no simple solution, there is no rose garden, but good governance principles can help us to make the right decisions. It has been stated already that we should work at 4 levels. First level, upgrade the composition of your board. We are talking about expertise, background, and soft skills. Second level, and we talked a lot about education. Education is the most powerful weapon to change the world. We should raise awareness in boards. Awareness not only about the technical questions, but also about the importance of integrating sustainability in the strategy of companies. Third level is the leadership. Boards should take leadership in putting into place the right management, but also to organize training programs and organize the planning that is necessary to make the transition. And fourth, last but not least, we have to move from reporting to disclosure. We have to develop a right disclosure approach that is appropriate for the relevant stakeholders. So as you see, governance is in transition, but governance is also a beacon for a world that is in transition. And with those hopeful words, I want to close the evening, not without thanking ENG for having us, for hosting us tonight. Thank you a lot, but also our speakers for their very interesting insights. And of course, also our members, our GUBERNA directors, our certified directors, and all those present who are not members yet, but future members of GUBERNA. And last but not least, of course, the team who made this evening possible. To close with, and then I really promise you that you can go home and or turn off your screen, I wish you all sufficient energy to have a warm holiday season. COVID safe, but happy and free. And I also wish you a very inspirational new year to be ready for the long way we will have to go together in 2022. Thank you.